Hello, everyone, and thank you for joining today's webinar. My name is Sujendra Mishra, Secretary-Treasurer for the AIA California, and I will be moderating this Economic Outlook presentation today. A few housekeeping items before we get started. Please do not use the chat box for any questions for today's panelists. Instead, use the Q&A feature. With the Q&A feature, attendees can like a question to move it to the top of the list. This session qualifies for 1.5 AIA learning credits units for watching live. AIA California staff will report those units for you once you've finished the session. As always, all webinar content and additional resources will be available on the AIA California website shortly after the session. Today's session will focus on the emerging developments shaping the future in California, current impacts on the design and construction industry, and will show a forecast for 2022-2023 as it relates to California, including residential and non-residential market sectors. Now, I would like to quickly introduce our presenter before getting this program started. Michele Russo is the Managing Director of Research and Practice at the American Institute of Architects, where she's responsible for advancing architectural research and practice prosperity, providing insights on the disruptive trends and overseeing AIA's business intelligence and economic work. Michele previously worked for Dodge Data and Analytics, where she ran its smart market research program, providing data and intelligence on the AEC industry trends, most notably sustainable design and construction. Welcome, Michele. Please take it away.
Thanks so much. Let me get this going. Can you see that?
Yes.
Okay, great. Thank you so much for having me here today. I've spoken to AIA California at a number of times, and it's always a pleasure. So I really appreciate being asked back, and hopefully it'll be worth your time. So let's start off by saying what I think you're facing. This is what we feel as if we're facing as well. So many different things coming at you, so much data, information. How do you kind of sift through it? How do you kind of move towards it? And what I hope to do today is kind of take some of those questions you have and turn them into insights. So kind of walk through it and maybe kind of help you make some of those decisions or figure out how to sort through that. Because I'm going to share a lot of data, but hopefully in a way that kind of contextualizes it for you. So I've split this out into 5 bits. First is going to talk about the overall economy that's on a lot of people's minds. I'm sure it's on yours as well. So a little bit of how we track that and how it relates to our profession, the architecture profession. Second, I'm going to talk about housing market trends, and then follow that with non-residential. And then I want to go into our Architecture Billings Index, or ABI. What does that mean? And trends we're seeing in the profession. So you understand what your peers are going through, what we're kind of seeing trend-wise. And then I'll end with an outlook, so forecast what's going to happen in the construction marketplace. So recession is on everybody's mind right now, and it is something we're looking at. Now, it's a word that doesn't really mean like what does it actually mean? It's not going to be the Great Recession. If there's a recession, which is about 50-50 now, according to economists, it's going to feel like the 80s. And so that is a different set of factors than those that went into the very long, protracted Great Recession. So what are the factors that are kind of indicating we might be headed that way? The first is some recessionary indicators. That spike in oil prices that we're starting to see, high inflation, interest rate hikes, stock market corrections, and an inverted yield curve is another kind of area that we track. On the expansionary side, we're seeing strong job growth, corporate profits, healthy household balance sheets, and aggressive kind of spending due to the stimulus, and high levels of home equity, which is always a positive side. Oh, yeah, I just realized. So what are the larger issues affecting our outlook? We've got economic expansion hitting some headwinds. So that is something we're being mindful of, but we are exiting a 2-year recession and things are booming. And so that also kind of gives us on a positive side. Housing sector surged, might be near the peak. I'm going to talk a little bit about that in the residential section. And then again about ABI strength in 2021 and really strong entering 2022 shows us an upturn in construction later this year and into next year. So again, I'll talk about ABI in more detail, but that's a leading indicator for the non-residential construction marketplace. So what does that mean for where the spending comes down the line? So I mentioned this uncertainty is out there, what's growing, what's not. So at the same time, we're telling you, yeah, there's lots of positive things going on. Let's talk about those first, and then we'll talk about the things kind of leading to that headwinds. First of all, the pandemic is largely controlled. So while the spread continues, certainly as things lighten up and people move into public spheres again, however, the mortality rates, it's becoming something that's manageable, often light impact. So that control is allowing for people to kind of return into to return to the marketplace, to return to doing things that then create a strong jobs market right now. So again, those are encouraging the economy. And that wage growth, and to date, there's been strong consumer spending. I'm going to put a little asterisk on that, talk about it in a second, as well as strong profits that are boosting that business investment. On the construction side, yeah, sure.
A quick question. What does ABI stand for?
Sure, the Architecture Billings Index. And I will just what that is a little bit later. Sorry for using the acronym, I know better. On the condensing side, we're seeing the prolonged disruption by global trade in that continued war in Ukraine. Not only is that affecting oil, but also there's a lot of groceries and produce that comes, or grain that comes from the Ukraine area. So food across their global markets, global exports, is also causing those things to spike. And we know supply chain disruptions are not just because of Ukraine. We have been having those problems since the start of the pandemic, and they continue. And inflation is the highest it's been in 40 years. That's pushing up the interest rate as the Fed tries to kind of contain that inflation, and we'll see how aggressive that has to be. But that means a lot higher costs for things than what we've been used to spending. And as well as has implication on both the housing and non-residential side. And labor problems are expected to worsen. So I'm sure you've heard there's a lot of jobs available, but what are those jobs and how are they, what's going to happen with the labor tightening? At the same time, you're seeing inflation come up and spending potentially going down. GDP has recovered from the pandemic. We saw pretty strong growth at the end of last year, up 6%. Which balanced out the depressed economy in 2020. However, we started this quarter actual at basically flat, so very little growth in GDP, and the forecasts keep kind of getting sized down, scaled back as we look forward. So we'll see if we end on 2%, but there's a lot of factors kind of going into that, and how that ends up playing out, we'll see. But either way, we're not looking at a strong growth year in GDP. If it is on the positive side, it'll sort of be around that 1 to 2%, we think, ending out the year. So we continue to track this. This does tell us kind of a factor of how healthy the economy is. In terms of where California are, you guys look pretty similar to where the national average is going. Had a little bit of a more positive 2021 rebounding off of the recession, but look very, very similar to national numbers. And so that kind of gives you a sense that where that goes is kind of how it's going to feel in California as well nationally. I mentioned the Federal Reserve. They tried to keep rates relatively stable going into 2021 with just these sort of quarter point increases, but have gotten more aggressive and have a plan to be more aggressive in the coming years in the forecast. And that is because, again, raising interest rates, which have been in an all-time low for years. Some of the longest stretch we've had of such low interest rates, which did encourage borrowing for those that made it through credit that made it through the credit history checks. But those increases will be more aggressive if inflation continues to sort of rise. Although indications are that this very high interest rate that we have, even if it softens down, we're at a 40-year high. We're back again, looking like the 70s and 80s. And so at that 8%, even if it slows down a little, you're still looking at highs that we're not used to at 5 or 6% rate hike. So those are factors that are kind of going into what happens, right? How much capital is going to be available to borrow? That goes into sort of both the housing side, slowing down spending. So we're hearing a lot about sort of the stagnation, which is more what we care about when we look at our profession. How slow, what's the growth going to be like versus sort of the word recession? What does that mean? But this sort of stagnation in the economy, that's when we're preparing us for slower growth down the line. And I'll talk about what that is in a sec. While GDP has recovered, payroll positions have not. And so this is I think you've heard about the Great Resignation or the great people not coming back to the office in some sectors. And this is sort of bears that out. We lost a lot of jobs and then people didn't necessarily come back to them. And we're seeing some professions really struggling to get people back in. And that's what's causing lots of delays along many of the service areas that we were used to pre-pandemic. On the unemployment side, we're back to about where we were. However, we're coming again back from really, really high unemployment spikes, short but deep. And so it's not as if, again, we have lots of jobs open, but there is still a consistent unemployment rate from pre-pandemic. I want a little bit about migration matters. So where have people in the US moved? In COVID, we did see the Northeast has been plummeted by far. The continue to lose people to other parts of the United States. The Midwest, while still again continuing to lose people, are losing people at a lower rate. So kind of seeing that momentum freeze. South is really where it is. It's where tons of growth is happening. Particularly in Florida. I'll show a few slides around that, and Texas. And the West had gained some population in 2019 and into the recession, but over the last year and a half has started to see those losses as well. Obviously with California being one of the states, but not the only one in that market. Coastal metros are among the biggest tops. So I talked about the Northeast losing, that's really from New York City. It doubles loss of anywhere else. People are moving out of the expensive cities. So your San Francisco and Los Angeles are in that bucket as well. And then Chicago, again, really moving out of expensive areas. That's sort of the trend here. Whereas the areas of growth are happening in what used to be cheaper areas to move to. Phoenix and Dallas topping that list. And then the next three, and also Jacksonville, all being in Florida. So we are really seeing growth there. What's interesting about California is that we saw San Francisco and LA kind of decreasing, but we're seeing Riverside, San Bernardino, we're seeing Sacramento as increasing. So kind of moving a little inland in California. So it's not that California looks like you're getting migration across the state, you're just getting movement away from some of these expensive urban pockets, kind of inland a little bit where it's a little more affordable and you're able to kind of stretch that money a little far. So there is kind of, where are we losing? New York City means we're losing a lot from New York. California looks a little bit different. So I thought this was interesting to kind of end the section on working, because this is a national trend and I think it's kind of interesting. So when we asked, so these several surveys kind of asked, are people going back to NBA games? So if you went to NBA games before, are you now back? And most of them are. If I was going to, now I'm going back to my basketball games. 90% of people who used to travel are now getting on airplanes. Almost 90% of people who used to eat out are now going out, but less than half of the people who used to work in an office are going back to an office. And I think this says a lot about cultural shifts that our behaviors, the things we like to do haven't shifted, but what we want from our work environment has. And that is certainly not missed the architecture profession. And so I kind of already talked about this slide. So what I want to talk about is on the plus side, the expansion areas, where is some of the risks? And that is in these areas. So corporate profits, consumer spending, and healthy household balance sheets are becoming less of a strength and kind of moving over to the recession side of the equation. And so we'll see, this is affected by inflation, by interest rates. So if you didn't borrow, so we saw a lot of borrowing, a lot of renovation, retrofit. We'll talk about that in a second in the home industry, but these inflation rates are leading to higher interest rates. So you're not getting to take out that money to invest back in your home. It's going to be tighter to get, therefore, you're starting to, the sort of healthy balance sheets from COVID, that money has kind of been going away, or people socked it away. And so the spending that they were doing is going to kind of be pulled back as things are more expensive. So we're just starting to see that. And we'll see kind of how it bears out. But that's why this kind of talk of recession is sort of moving more towards, yeah, there might be one. But for us, we look at how does this affect kind of the construction marketplace. And in the non-residential side, it lags the economy by about 18 months. So, and because there's so much uncertainty kind of around this recession that might be coming, it is really more about, could there be a turnaround or freeing up some of the supply chain stuff so it doesn't affect non-residential construction because it lags the economy. So there's still some kind of uncertain conditions as to how this will affect most of the work that architects do. I'm going to talk about residential housing market trends next. So just want to pause. Was there any sort of specific questions, or can we hold to the end for clarification questions?
It looks like we're good for right now.
Yeah, we're good.
All right, so let's move to housing. There's several issues facing the residential sector. So one is home building. We have seen pretty nice recovery. We talked a lot about the tale of two marketplaces, the tale of two economies. Last year, while there was a blip, the housing market actually stayed pretty strong. And any of you working in single family housing stayed super busy and are still super busy. Housing prices, however, are increasing at unsustainable levels. We're seeing mortgage rates rising. It's expensive to buy a home. So therefore, concerns of a housing bubble are growing. And there's variation in market conditions regionally. So I kind of talked about some of those movements of people. That's also leading to housing looking really different. Areas that used to be affordable starting to become less affordable, while there's still huge competition in urban areas. So the pandemic propelled housing starts. So again, I talked about how housing's tale of two markets. You can see construction activity in single family housing in 2020 increased over 2019. It continued to spike even further in 2021. And projections this year is that, again, we're going to see more of that building happening in both multifamily and single family residential. Now, these might be controlled a little bit. So I would expect some of these projections to go down and stabilize to the end of the year, because housing is on the front end of an economy. So again, if people aren't able to get out money, able to buy these homes, or wanting to kind of hedge bets with things more expensive, so not necessarily move up, we may see this temper a little bit, but still looks okay in the short run, but it is a number we're keeping our eye on. We're also, though, still underbuilt. So you can kind of see historically, there's always been about 13 to 15 million housing starts, but over the last decade, 2021 to 2019, significantly less. And so as we kind of go into the early 2020 and so on and subsequent, there still is this sort of backlog, lower levels of home building. And some of that is why there's parts of the United States where you're fighting for housing prices, fighting for a place that doesn't have a lot of stock, right? It was just in one of the suburbs of, actually now a suburb of DC, but out in one of the western parts of Maryland, and they're starting to see growth, but they just haven't built, right? Because it was a more depressed area. So, we're starting to see cities that kind of look like that, a place that didn't have a lot of housing starting to get this kind of migration and not having the stock to meet the demand. On the custom residential, so we do a quarterly survey of custom residential architects called our Home Design Trends Survey. If you do single family work and are a panelist, thank you so much for your contributions. If you're interested, please shoot me an email. We'd love to add you to that panel. And so we ask them at each quarter, how are their billings, the inquiries, the calls that they get, and the contracts they're signing look. And again, you can see other than the very beginning of the pandemic and the end of the first quarter of 2020, it's been really healthy. Billings have been up, contracts are being signed, and phone calls are even higher. So really healthy conditions in single family. Project backlogs also remain really healthy. This is, I think, pretty consistent for people, and I'm sure all of you feel the same, can't get to a new project for 6 months. So these can be healthy because they kind of get things on the books. It can also be a little risky, especially if a homeowner hadn't taken out the money especially for residential upgrades or remodeling work. So now as we're going into these higher interest rates, we might see some slowdown, some cancellations in the backlog, but we'll keep our eye on that as well. But right now it's pretty healthy business conditions. When we look at the 25 top home building marketplaces, again, they are concentrated in the South around basically the coastlines. San Francisco did make that list. So there is building going on, likely because of shortages and the tight housing market conditions. So if you can open up more housing, even with the migration, it's still a populous area. Philadelphia, one of the most affordable areas in the Northeast, has seen a big rise again as people are kind of moving into some of the places that are more affordable. In terms of nationally, we are seeing prices recovered. I talked about this spike, potentially non-sustainable, but it is, again, when we see how strong that is, it starts to sort of make us look at, is that sustainable? Likely not. What is the standard of living, right, which goes along with those house prices, and where is that going to lead? So it is a leading indicator for us to look at. And as I mentioned, again, with that price growth, that's an unsustainable path. So San Diego is among the highest in terms of the growth, or the growth rate, the change in housing prices over the US average. So that's pretty substantial, a 25% increase. National average, 20% increase just over the last year. So we're seeing housing prices kind of go through the roof everywhere. And that's not healthy for the average consumer part of the economy. In terms of what the work is going on, I don't think this surprises anybody that remodeling and renovation is where it's at. We are seeing that kind of pull back on first-time home buyers, affordable housing. That's because those are the folks that fared least well during the pandemic. The white-collar workforce, for the most part, actually made it out and recovered nicely and got a boost from the stimulus money. And we're sort of seeing that in some of the single family, but generally across the board, other than that area, it's still pretty solid, not as solid as the growth in 2021, but still a year where there's a lot of work that's being requested on the housing side. In terms of where renovations are going, and this is kind of what I talked about, that same migration, people that might live in these areas that are more affordable, kind of little inland, the top 10 markets for home improvement continue to be sort of the Sun Belts. We're seeing a lot of traffic moving into these areas, as well as investments in people's assets who already live there, in order to either sell to some of the folks coming in, or to kind of build up their asset value as these economies move up. Overall housing starts expected to modestly improve this year, stabilize in 2023. And so again, how we look at this will this will be affected by some of these conditions I've been talking about, because housing, again, is kind of more on the front line of an economic downturn. So I'm going to end with the bubbles. I kind of started talking about some of the forces on there. So what are the things that are potentially going to help lead to this housing bubble concern? Again, repeating the increase in housing prices, the household income ratios are non-sustainable. Mortgage rates kind of moving up really rapidly. How rapidly they move up is something we keep our eye on. These bidding frenzies, usually an indication of a potential bubble coming. And in the amount of investors that are a share of home purchases. So that's also kind of not people moving to live in them, but moving to flip them. Another indication that potentially there's a bubble going on. On the it's overheated, but it's going to be okay side of things, there is still that really strong demand. And we are seeing the millennial generation reaching kind of home buying ages, right? As they start families and need spaces and of their own and are in solid jobs that have good incomes that are stable. So we are starting to see that. And again, I already mentioned the undersupply. So there is a lot of the tightness that's not necessarily that's being precipitated by the availability, not necessarily because it couldn't be managed if there was more supply. Mortgage underwriting is tighter, so that's a good sign. So as I mentioned, some of the precipitating factor of the Great Recession was the openness of credit. So that's been always contained coming out of that, and the fear of that going wild again. And in some cases, potentially like tighter than it should be. Like there could be credit that's been advanced, but lenders have gotten really cautious before lending out because of that sort of memory of recent times. So but that means that when people are getting loans, they're able to invest, they have good credit, they're not going to not be able to sustain those home prices and sell them. So that's a good sign, actually, of where things are going. Mm-hmm. And finally, their homes are becoming worth more. And if they decide to sell and move to some of these cheaper areas, it's giving them more asset value. So it's helping them move out and have that financial security within their homes. And that housing can often be a hedge on inflation. So it's something we keep our eye on. And as we're going into these conditions, housing will get hit first. So that's why we sort of look at that. Is there any clarifying questions in that before I move to non-residential?
Michelle, there were two questions that came in, and sure. One of them was from Charles. Bloomberg indicates that real estate is an unfavorable equity sector preference. How should architects think of focusing on sustainable market sectors that are real estate adjacent? And then the second one was, I think it's a more general question. We've had a loss of over 1 million people due to COVID, and what effect that has on the economy. If you want to address that now or later.
Yeah, that's a great question. I'll start with that one. Where COVID has had a disproportionate effect on our economy and on the people that were impacted by it. When you look at the million people who have died from it, they are disproportionately older Americans and disproportionately people of color, and who have lower incomes. And so this has a lot of impact on us as a society. For where residential architects do their work, it's not in either population group. But we are seeing, but it is problematic from a nation and who we have living in our country. And affordable housing certainly has been affected by that rate, right? So COVID revealed a lot of the inequities and flaws in our economic systems and who benefited and who was hurt by the recession. So I would say our residential folks were sort of insulated from that because of who was most disproportionately affected by the pandemic. So I think that is something we don't have the ability to solve ourselves, but certainly can be stewards of that as citizens of our country. So on that side of things, in terms of real estate adjacent, yeah, I mean, with housing comes sort of the infrastructure around it. It is a risky place to invest. Obviously, we saw that with the Great Recession. I think there's been a pullback on real estate because of that, right? More cautiousness in lending. I can't, it's not kind of my area, but I can kind of ask around and get a little more clarity on that and distribute the answer after the call. Yeah. All right, so let's dig into non-residential, which looks a little bit different. So what's the outlook for non-residential housing? And there's non-residential building. And there's three things I'm going to talk about. Construction activity being on the upswing. We had two really kind of down years in construction spending. So what is that now looking like? Second is material price volatility, supply chain disruptions, labor availability. Those are all problems for our industry. And existing building work being on the rise, and that has multiple positive consequences. I'll cover that. So first, kind of talking about construction activity. Institutional is where most of the construction work happens in education and healthcare. But right behind it is office and retail, which is where we've started to see growth, but still some areas of concern. I'll kind of talk about where that is. So just to kind of give a picture that when we look at the big four, that's comprising over about 2/3 of construction activity between office, retail, education, and healthcare. So let's look at the spending numbers. So I'll talk about our Architectural Billings Index in a little bit because it talks about the health of architecture firms. But one of the things it also does is kind of predict where the non-residential marketplace is. So if our ABI indicator is below 50, it means that there's a contraction coming. If it's over 50, it's suggesting billings increase. It is increases in billings, which suggests non-residential market will be improving. Well, 9 to 12 months ago, we started to see an improvement in the ABI, and now 9 to 12 months later, we are seeing spending start to go up. So that kind of bearing out is a strong indicator. And I want to talk about, I mention this on every presentation I do with architects because it's kind of awesome, the impact that a 200,000 person profession actually has on the economy. So the billings of non-residential firms, just whether it's up, down, or flat, actually predicts where the non-residential construction market's going. Wall Street analysts pay AIA to get that simple index from us. So it's a really powerful message to be able to say that we have the work that you do is so much, is so integral and important for where the economy is going. So just those measures in the aggregate really help us look at health. And so I mentioned that now because it sort of is bearing out in this cycle, just as it has in the past. We're seeing particularly strong growth already happening in commercial and manufacturing, as well as healthcare, which was relatively flat throughout the recession, one of the few sectors. Still seeing lodging soft. There's a lot of reasons for that, mostly pandemic related. Education as well, still not yet turned around, but I'll talk about the forecast kind of at the very end of the presentation, kind of showing where some of these are expected to be in the future. So this is current state of spending. And again, trends are really positive. Similarly, when we look kind of at urban, so we get down to more of the local level, metros that saw the declines in 2020 generally had gains in 2021. So that ended up being healthy. Particularly you see in San Francisco, there was the gain off of the decrease. LA looks a little different, still continue to have a slow 2021, but indicators are that that's kind of stabling out in 2022 with spending. So next I'm going to talk about materials price volatility, supply chain disruptions, labor availability. These are things that you also hear a lot about and you all know a lot about because you're dealing with it every day as you go into projects going under construction, even if you can get the upfront part of the work done. Construction costs for the key commodities have continued to be volatile. And while these look small, the only reason the scale is so high is because we had seen a doubling of these same commodities over the last 2 years. So lumber, which is now flat a year over, just 6 months ago was double where it had been the year prior. So we're seeing these these increases continuing on increases. So compounding the cost of products and the availability of them leading to the cost. So I'm sure several of you kind of have felt this where you have projects put on delay just because you can't get steel to the site. And so, or lumber for that matter. And so these are the kinds of things that are leading to cost escalations of projects and are certainly having effects on where we can deliver the projects once they've been designed.
Michelle, a question on the previous slide from Eric. Is is a lab or life science included in your healthcare numbers?
Sorry, can you repeat that?
Yeah, on the previous slide, is lab or life sciences included in your healthcare numbers?
Yeah, so, well, it's actually split. So some labs are in universities, depending on if they're related to a public or private universities, but most labs are in the healthcare sector, yes. Thanks for that. Okay. So moving on to material prices and continuing that, it does continue to be, when we survey architecture firm leaders, the supply chain disruptions continue to be something that most firms have some concern about in terms of the seriousness, with only a very few saying, I'm not really concerned about this at all, or things haven't changed. So that kind of 20%, but the other approximately 80%, are having concerns and seeing issues. What that's leading to is really conversation, talking to clients, keeping them, being their consultant, keeping them aware of what's happening on their projects. So that's kind of a third of architects are reporting they're doing that. Another sort of fifth are saying, yeah, we actually are looking at the materials and products we're using and changing those up, or kind of looking at our cost estimations and building some of that into our bids and our work with our clients. So again, that's sort of the conversation is leading the way, but then adjustments to the design and cost piece being another thing that is how firms are kind of grappling with this uncertainty. On the contractor side, we ask, how's this kind of changing your relationship with buildings, with the builder side, and a third are basically saying we're telling them to order stuff earlier, right? So I think they kind of know that. So again, this is like, that engagement piece, those conversations, the engagement about it over a fifth saying, prior to bid, we're trying to have those conversations with the contractor that'll come on the project. But about a little over a fifth are giving more freedom and substitutions. That was a little bit of a surprise for us that it was that high, but I think that's kind of just wanting to serve the client better and providing that flexibility I mentioned before, being more mindful of the materials putting in and how there can be some savings and costs for the client out of that. I'm going to switch quickly to the labor side because the construction trade, or been in the labor side, but on the construction trade side, there's heavy reliance on foreign-born persons, but lower shares of the people who make up the bulk of the workforce, which is women and older workers. And so we have seen a lot of people retire and leave the construction industry. It's still a tough job for older Americans. But this reliance on foreign-born labor and all of the issues we're having around immigration kind of makes it a very risky profession to go into the construction and the trades. It's also not a career path that most young adults are kind of interested in. Only 3% of 18 to 25-year-olds reported a few years ago that they find this profession appealing. Certainly if innovations take hold, if technology takes hold, and you see more computing skills be needed in the construction industry, if things get automated, it could potentially be a more interesting career to a more tech savvy young group of young people. But right now it's not only a place that that's part of why it relies on foreign labor. However, on the flip side, on the architects, our profession, we aren't losing people. We aren't losing people. So like some of the other professions are, but we don't have enough people to keep up with the work. So what we are finding, because I know labor is an issue, and we'll talk about that in a little bit, is that firms are losing people to each other, not necessarily people migrating out of the profession, which we did see kind of that happen more during the Great Recession. People left and didn't come back, particularly people who were at the mid-range, at the kind of mid-level project manager level, who were usually a little bit older, had families and so on. So we aren't seeing that. We didn't see that in this downturn. We have fully regained. We're actually over where we were prior to the recession. Everybody's really busy. So I'm going to end this section on non-residential trends by talking about existing building work. We're seeing a larger share of construction billings work coming from the renovation, addition, and preservation work. So this bucket of existing building work, we're projecting that it's going to be over half of billings when our firm survey comes out later this year. So that's pretty substantial in terms of sort of bucking a trend and continuing to give us opportunities of where work is happening on the non-residential side. We know in residential home improvements, kind of obviously people investing in their assets have been on the rise, but we're also seeing it in the non-residential marketplace. Some of that, in terms of the share of the billings by numbers, again, that 52%, this is kind of how it's spread out. That's average. So you're kind of seeing most people sit in that 25 to 75% range. But there is about a fifth that are saying almost all my work now is coming from renovation and remodeling work. So that's a shift that we didn't see in the past. In terms of what type of projects they're doing, most of it's adaptive reuse. So that's not kind of, or interior modernization. So that's not surprising. I think coming out of the pandemic, people realize, hey, I've got all this space. I actually want it to be able to do different things depending on the conditions of my workforce or the needs that I have. Or potentially, if you're locked into a long-term lease, do I need to get a sublease going if I end up not needing the space I used to need? And so that adaptive reuse is certainly an area, or if a school building's going in because they expect the school population's increasing, but in 10 years thinking, oh, maybe it's contracting. So wanting to remodel a space so that it can, or rehab a space so that it can be used for multiple functions. We're seeing that really take hold. And again, the modernization is a product, I think, of the changing conditions of what different sectors need. So education's been shifting, has different needs, healthcare, obviously, as well with technology innovation. So that's also a big place where existing building work is coming. Tenant fit outs and adding usable space being the other two that top the list. In terms of what it was motivated by, on average, about 10% of reconstruction people do report was related to the pandemic, specifically impacted. But I think some of those conditions I just talked about that are kind of pandemic induced or brought light during the pandemic, this, oh, I might want flexibility, certainly also having an impact. But again, that average of 10% of that work being directly precipitated by the pandemic. And another factor kind of influencing this residential work is the need to have projects that are more resilient, that can hold up or adjust to changes in the environment. So this is where I talked about some of the opportunities with existing buildings. For investing in these existing assets, we can start to lower embodied carbon of those buildings, lower operational carbon, through energy efficiency measures, build resilience so that you have assets that are withstanding these natural disasters. So again, big opportunity as we come out of the existing building marketplace part that, as we try to meet up our climate challenges, and being part of that solution, certainly tackling existing buildings is one of the easiest is probably not the right word, but one of the most direct ways that we can help contribute to those decreases.
Michelle, a question on the slide.
Sure.
Does the percentage for resiliency seem low to you given the natural disasters?
It does. I think it's a little bit of tricky. Yes, I think that was back here. I think it's a little tricky because it's a tricky word. And I think people define it differently. We have a study that's going to be coming out hopefully in just a few weeks. So we'll make sure we get it to all of you. And it's a survey of architects, contractors, and owners as well. And what's interesting is I think it's just an argument that's been hard for some architects to be making. And one of the reasons why, so one of the top line findings of the study is basically saying owners think building to code is done. Like you build a code and it's resilient. Nothing's going to happen to my building. I built it to code. I'm really good. And so that kind of the overlaying of the client perspective, I think is reflected in these numbers. I think this and also I think that's coming. So I think it hasn't hit at the same way that it will be once we're kind of equipped to deal with this. So I think the reason why more of that building is coming from this adaptive reuse and basic and the interior is because people are thinking how they use their space today and thinking like, oh yeah, like of course it's going to withstand because my building was built to code. So I think that it's kind of reflecting some of these emerging conversations with clients and honestly a different type of intervention than the kind of immediate, I've got a lease for 10 years. What am I going to do with my space coming out of the pandemic? So, and when you see the forecast numbers, we're seeing growth in office, for example, and in retail. And those are two areas in particular that they care about, as opposed to some of the institutional owners that are kind of really want their assets to be resilient, stay in place. We saw that with the green building movement too, right? It really started in institutional buildings and then made its way to commercial properties. Anything else on that?
So thank you.
So let me kind of tackle what's happening in architecture firms. So I talked a little bit about what ABI is a diffusion index. And again, over 50 means architecture firms are growing in their billings. And we've been over 50 since the end of the first quarter of 2021. And then I talked about how that's predictive about a year, and we are starting to see those turnarounds in non-residential construction. It always makes me feel good when the numbers bear out. We saw a big spike last month. The numbers just came out yesterday. So you are seeing this fresh off the presses. I haven't even posted it on my LinkedIn yet. But the number, again, really strong growth in April as well. So billings are continuing to be really hot. And contracts are also continuing to be signed at a higher level. And backlogs as well, highest they have been since we started measuring this back in 2010. So while this is a good sign, right, it means you got work in the pipeline that's coming your way. It helps to kind of support the what you have. It also can be risky, right, because projects can be delayed or put on delayed or canceled. It also can be tough if it also can be an indicator, not just that you have business backed up, but that you don't have the people to do the business, right? So that also leads to backlog increases. So it's a measure that's generally positive, but is also one that could be hiding some other factors going on. In terms of sector-based, where the billing growth is happening, again, you're seeing this big spike in commercial. And so again, that kind of goes to my answer to the last question, which is why sort of adapting spaces is pretty big right now. That's because that's kind of where the work is happening. But institutional also seeing an initial rise, a little bit slow Q1, but then coming back pretty strong beginning of Q2. So starting to seeing growth across all the sectors. Multifamily also particularly strong this year. Regionally, again, pretty strong across the board. Northeast always lags, or has been lagging for the last few years, but big, strong resurgence in the West, where you guys are this year. being even stronger in the Billings Index. So a good sign for us. Firms are busy. It means construction spending is going to continue to be strong for the next 12 to 18 months. And so those are good signs for keeping parts of the economy going. And firms came into the year really expecting a good year, right? And part of it's that product of billings, right? So most firms being like, yeah, we actually are really positive, with about a little over a fifth saying, I still think it's going to be a little challenging for us. This number changed a lot from when we asked about it in the middle of 2020, where there was a lot of concerns about firms and non-residential side, but really a different outlook 2 years later. And where they expect, how much they expect that revenue growth, also pretty healthy at an average of 7%. And we're seeing 20% of firms, a fifth of firms saying, I think my numbers are going to be over 15%. So a pretty good time, a pretty healthy environment right now. So kind of talking about, so that's kind of the ABI, what's happening within billings and what do those mean? But I want to talk about some of the other areas we probed recently as they relate to kind of architecture firms and business. So first is general business concerns. Second, I'm going to talk about firm expenses. And finally, staffing, which is on everybody's mind, and we are no exception to that. Business concerns. Going into 2022, we we probe on several areas of business, firm management and strategy, kind of about ways of running your firm, project management, marketing, developing. So kind of that side of the business, the actual design work that you're doing. So being able to deliver projects, staffing and professional development. And then operating this sort of post-pandemic issue. So areas of collaboration, communication, remote work, how productive are you? Kind of that battery. And where things ended up. So the blue is those firm management categories, yellow project management, and red is staffing. Of the top ones, I'll just put them all up there. You can see that, honestly, firm profitability always makes the list. It's always top of the list. But the staffing ones certainly moved up in percentages from the concerns that firms told us they had going into 2021. And materials costs spiked. It's now the second highest concern. It was not in the top 5 going into 2021. That's when we started to see all the supply chain stuff starting to happen. And certainly going into 2019, it had been even lower on the list. Always made the top 10, but had not been the highest that it is now. And finding candidates continues to be a struggle as firms are really busy and not able to find people to help them do the work. The leadership transition is another area we keep our eye on. Firms are expecting that they're going to see retirements and being ready for that. Ready for succession planning is not something that all architecture firms are doing. Particularly small and mid-sized firms really struggle with this, as they don't have as many people to create a really strong pipeline or pathways into leadership. So I think firms are being really creative. We're starting to see some kind of ways of looking at succession planning, but it is of concern for a certain percentage of firms that are really worried about this. So now going into firm expenses, this is a new area we just probed on. When you think about staffing, and certainly that's part of it, but there's other expenses that plague architecture firms, and with inflation coming, how concerned are firms about that? And most of what we found is that there's actually quite a bit of concern right now, or at least something, right? Only a fifth are saying, I don't really have concern about my costs right now, or the ability to retain and recruit. Oh, sorry, this is actually about retaining and recruiting staff. So there is some extreme concern around the staffing part. Sorry, I kind of flipped this around. So I'm really sorry about that. In terms of future satisfaction, So I'm actually talking about staffing, firm culture and work. So we talk about firm, there's such a need for staffing right now. But what is it that's going to bring people to your firm? And typically it's only been about pay, but it's not only about pay anymore. It also is about the culture that people are coming into. So again, I mentioned that employees are hopping around firm to firm, as opposed to, it's not a profession you can just leave one profession and come to, like, oh, I work in association management, I'm going to be an architect, right? So it is a profession that requires a lot of training, a lot of time. And so therefore, you're trying to entice people from other firms. It's not only about pay. We're actually seeing a lot about the conditions. How much can I influence the culture? How comfortable is it? How do I fit? Like, these are really concerns we're hearing from younger professionals, but firm leaders are very aware of it as well. And so for the first time since we've been tracking this, that became the #1 area or most strongest factor of satisfaction of their staff, where compensation has always been the #1 factor. Following that, advancement potential, what design they can work on. Sort of this, I mentioned the number earlier that half of the workforce in the United States have not gone back, and nor do they want to go back in person to the workforce. We look a little bit differently. About 30% of firms report that their staff would prefer to work primarily remotely. So certainly that's very different from pre-pandemic. But I think we're sort of that over a quarter that say, no, hardly really anyone doesn't want to. We think that's influenced by more small and mid-sized firms who have a different culture, maybe never closed down during the pandemic, already had more flexibility, or their firm culture is around that collaboration piece. And so we are still seeing that, there's portions of our profession that kind of aren't as much as this call for full remote, but still, 29% are saying, yeah, our staff don't want to come back to the office in the same way that they did before. So what are the most effective strategies to address these staffing issues? Well, one is compensation strategies. So the other, employee benefits and perks, staffing, workforce shortage, staffing strategies. So we talked about that. How you can manage your firm and your projects differently. So in particular, the tops of the list are increasing salaries. So that is something that we know most of you are probably tackling if you're hiring, or to retain people. We're seeing bigger increases in people coming on board than retention, which can also create some strain in culture, but to sort of ramp up those workforces. But we are seeing almost as many, about a third saying, I'm changing how I offer salaries to attract qualified candidates. And so sometimes people are building kind of escalations in that related to how successful the firm's being. Again, firms are trying to be mindful that if conditions slow, they don't want to have to lay people off as they're trying to ramp up staff to do the lots of work that are in their pipeline today. So it's kind of like a really fine balancing act. And I think that's why this flexibility, these additional perks, they don't cost much or anything to the firm. And it really can go a long way at creating a culture someone might want to come to or be at, right? Because it allows you to have a different type of work-life balance, or be able to move to one of these more affordable areas, because we talked about how housing affordability has become an issue. So I think those are all kinds of things that firms are using. About a fifth, which is still a substantial amount, are saying, I'm delaying my project schedules. I just can't get to work fast enough. And it also creates a little bit of an ease on needing to hire someone. Benefits, expanding benefits packages. So more leadership training, professional development. We already saw a lot of firms paying kind of ARE prep and paying for licensure, but maybe giving bigger boosts after licensure. So some of those kind of perks firms are trying to account for as well. But again, we'll try to modify expenses Kind of lower on the list are people looking to contractors or increasing revenue, which is always a little bit of a challenge. Outsourcing work, so less of that engagement in trying to tackle this recruitment and retention. So obviously I reversed the slide, so we're really going to talk about firm expenses now, and the cost of running a business being really of high concern to architects. So 80% of firms are saying, yeah, the expenses that I'm tackling are really challenging. And where are the largest shares of that coming from? Well, it's coming from the people. So typically the big three is my cost of my office space, healthcare, and liability insurance. So those are usually the biggest three expenses. And what we're finding is that really healthcare and the insurance pieces are the ones taking the biggest thrust. But when or where they're seeing the biggest increases, and there's a lot of reasons why I think the office space piece, or where we think the office space piece isn't as much of they don't see the costs increasing for that. It's probably because they either already had the lease in place. Architecture firms usually do long-term leases. They've already had the lease in place, so that's not really changing what they're going to be paying. Or honestly, they're looking for less space. So that means it's not going to increase as much as maybe stay the same as they sort of adjust while lease rates are going up. I need less of it. So kind of a balancing act. But technology was one that sort of popped up high on the list. Those expenses being higher for firms is an area of concern. And when we asked them to kind of pinpoint what the biggest kind of area of increased expenses, it sort of splits. So, but more than a half, or it's kind of all around the people piece, and that's on top of the salaries. And then the other bits being really around technology and split between those firms that need it for business and those firms that want it for design purposes. And we are finding a firm size split. So it's easier for larger firms to have those technologies in place across the board. So they're finding more challenges with cost of technology for design purposes as they already have some of the base technology in place, where smaller firms are really trying to get better, more efficiency into their business and technology that helps them do that. So increasing those prices. What are the traditional cost-cutting strategies are just not being as heavily adopted. So so things like outsourcing tech support, deferring capital investments, moving to less space. These are all kind of really low, and what's really high is the none of the above. And so it's not these traditional strategies. They're looking at kind of other ones to sort of manage that. And we want to dig in a little deeper to what's in that none of the above bit a little bit. Again, their office space needs, I kind of talked about this. Some of them need less. That's where they're probably renegotiating lease agreements. Most of them say the same. Some of that's because they're locked into agreements, or they really are back in the office and they need more space. And then there is a share that's saying I have a greater need. An interesting trend, it's very anecdotal. And so we're kind of starting to track it and see if it's a trend or if it's just kind of a few firms. But one large firm said, hey, and we're sort of making our in-city offices smaller, and we're actually opening kind of smaller offices and leasing kind of cheaper spaces, but that are close to like a pod of staff where they live. And so it's kind of adjusting. I need more space, but I need less expensive space, and I'm trying to lease sort of smaller pods around. So kind of a really interesting twist, whether that's something just this one firm's doing or a trend. It's kind of an interesting one for us to sort of see, is that just sort of one approach, or is that happening elsewhere? So I'm going to pivot to the outlook to bring us home, but is there any questions in that section?
Michelle, one question that came up as far as strategies are concerned, and this may not impact firms that have contracts that only do adjustments at the end of the year, but the question was that are you seeing a trend in architectural firms revisiting billing rates in the light of cost increases, especially in California?
So that's a question we don't really talk about. So I can talk about revenue overall, but we start to kind of get into discussion around antitrust, and AIA doesn't kind of comment on that.
Right, but it seems like the none of the above kind of falls into that category.
Could potentially, yeah. It's not an area we probe on. And, we are seeing increase in revenues that can come from a lot of different places. It's law of supply and demand. If you have higher costs, you got to lower the things that cost money, or you got to increase the things that will bring you money. Whether those come specifically from fees, or how much come from fees, or how you negotiate fees. We obviously have some resources that help kind of go into how you determine fees. Those are part of our best practices on ai.org/best practices. But in terms of what's actually happening, there's some consultants that can report on that, but we don't.
That's all for questions. Thank you.
Okay. So let me just wrap with the outlook. So what's going to happen? Everyone also wants to know where's business going to be looking forward. And so Kermit Baker, our chief economist, works with the leading construction economists, and he takes all their forecasts and then averages them. So our actual consensus forecast performs a little better than most of those individual forecasts because it sort of dampens some of those that have more aggressive outlooks and sort of makes a little lighter those that are more conservative with their outlook. Overall, total non-residential construction spending levels pretty strong, but expecting to see a decent increase this year and even stronger increase next year. So again, the inflation, kind of some of the recessionary impacts, this is lagging on that. So again, still kind of expecting growth into next year. And commercial side, a little flatter. Industrial's been doing quite well. And institutional, while a little bit slower, again, being pushed mostly by healthcare so far, expected to have residential come back, kind of dig into the sectors in a second, but seeing even kind of stronger growth next year for institutional buildings. Let's look at the commercial marketplaces. The real rebound in hotel. So you can see kind of big rebound in hotel. This is also coming off big decreases. So we have the 2021 to 2022 change, which was basically about flat for hotel. But if you look, if we were to look back at the change between 19 and 20 and 20 and 19, and 21 to 20, you can kind of see it came off of extremely low numbers. So even that strong growth that's expected next year, the flat this year, you're still not going to be anywhere near where that marketplace was back in 2019. But if travel starts to pick up, if people start to have conferences again, business conditions start to move up, people are looking to travel for vacations as opposed to, driving to them. We'll see some of that movement. So there is expected to be growth in 2023, but it's coming off extremely low levels. Office, on the other hand, expected to be pretty flat this year, already seeing some of those spending turnarounds, but also increasing in growth next year. A little bit healthier in the institutional side, as I mentioned, looking at a 6% increase in 2023, but 4% this year. Healthcare kind of leading the way with relatively strong increases this year. They never really had the impact from the recession. So people's kind of specializing in healthcare, although there are, to the question about labs, there are different aspects of healthcare. So it is dwarfed by hospital expenditures, but and medical centers, those convenience care centers, also that's been construction on the rise for the last decade, actually, as people kind of move from ambulatory care to these moving out of doctor's offices and into these convenience care centers. Education expected to kind of rebound in 2023. Sorry, yellow is 2023. But have a little more modest growth. So we haven't quite seen the spending increases, if you remember kind of where we are right now, but expected to end the year at 3.5% growth. So I'll just stop and take questions from the group. I do see some things in the chat. So I know we weren't, I want to give a quick look at the chat, even though.
Michelle, there are no questions in the chat, nor
oh, great. Thank you.
Q&A. Right, seeing no questions.
On people's minds.
I don't see any additional questions, so I think we can close the session. I want to give a big thank you to Michelle for this extremely informative presentation. If you made it this far, the AIA California staff will submit your AIAC credit for you. It'll appear on your transcript in the next few weeks. As always, the recording of this presentation and additional materials and tools can be found on the AIA California website. More details on our upcoming webinars and how to register will be made available to you in a follow-up email. Thank you for joining us, and we will see you at our next webinar.